Well, the curious riddle of Australia's economy right now is that Australians have spent at record levels for each of the past 5 months. Yet for 7 months, consumer confidence has fallen and now is at increasingly dangerous low levels. Then there are business conditions. They're still good, but it has to be said they're tapering off. To help work out this conundrum, I'm joined by Westpac senior economist Matthew Hassan, who's great with his time as always. Matthew, okay. Take me through this riddle. Clearly, you put the consumer confidence numbers out. They're showing a significant fall. Retail numbers are strong. Prices, we know, are rising. Is it just that consumers now appear to be dipping into their savings?
I think it's partly the post-COVID puzzled economy. There's so many things going on at the moment. We're still reopening in large part. We're seeing from the travel figures, we're only back to about a third or 40% of pre-COVID levels in terms of parts of the economy which are still getting back on their feet. And there's a lot of activity that was basically prohibited during COVID that is normalising. At the same time, yes, there is a big backlog of funding, whether it's savings set aside during COVID, very high savings rate even at the March quarter. But beyond that, I think some of these other indicators, like consumer sentiment, are going to become much more important. Really, our consumer sentiment survey is flashing bright red at the moment.
Well, have a look at it. You can see it there. Just explain to people in perspective what it means of having seen it fallen from nearly 120 now down to around 85. What does that actually mean in terms of the economy overall, spending, the way in which people behave?
Well, look, the great power of our survey is that we've got nearly 50 years of history to benchmark to. We've only seen those sorts of reads on consumer sentiment and that scale, that pace of deterioration heading into major disruptions to the Australian economy. We're talking things like the COVID pandemic, prior to that the GFC, the early 90s recession, the mid-80s sharp slowdown, the early 80s recession. Those are the comparable periods where we've seen sentiment fall in this style. And so I think it really is flashing red at the moment. It's telling us that in many ways the consumers like the cartoon coyote off the edge of the cliff at the moment. There's still all this momentum they're carrying over from the COVID period, but beyond that they're facing into a very abrupt slowdown once these sentiment factors start to flow through.
Okay, so that's all about rising interest rates and the message that's coming that's saying that there's big interest rate rises coming. I noticed the NAB today, for example, said it believes that the cash rate's going to peak at 2.35%, you know, another basically, 0.75% interest rate rise from where we are today. But I just want to take you to that because I wonder whether all of this sentiment is doing some of the work of the Reserve Bank. In other words, the jawboning, saying, hey, it's coming, you better be careful because we're going to whack you pretty hard. All of a sudden, sentiment changes. That takes away some of the inflationary pressures, surely.
Sure, it's part of the game. It's part of the tightening process. Consumers have been clobbered by interest rate rises, back-to-back 50-point rise. We haven't seen anything like that since the mid-early 90s. And it's showing through in their sentiment reaction and also their expectation for rates. The market, NAB might be expecting 2.35. 75% of consumers expect rates to rise by more than a percentage point over the next 12 months. Yes. They're expecting much more from the RBA. And whereas in June, the pre and post RBA sentiment spread was about 2 points, this time it's about 7. It's really starting to bite. Those moves, each time the RBA goes 50, it's really biting into consumer sentiment. And that's the nature of the target here, trying to slow demand in line with these capacity constrained supply side issues that we've got.
Okay, but then there's also out today the NAB Business Survey, which is one of the most watched business surveys around the place. Again, like your consumer sentiment survey, it goes back a long way, and the Reserve Bank watches it closely because, of course, where the consumer goes, business tends to follow. But its conditions still showed very favourable sort of conditions for business, even if they're coming off.
Again, I think what we're seeing is the coyote over the edge of the cliff, right? The business conditions measures are telling us that normalisation in activity is still flowing through the economy and spending here and now is still okay. What the sentiment and the forward-looking measures, confidence in particular, is telling us is that there's a significant abrupt slowdown around the corner that we need to be very wary of. I think what the RBA will also be a little bit concerned about from today's business survey is very clear cost and price inflationary pressures, including around labour supply. And I think that's going to be one of the perhaps the more eye-catching aspect of today's report.
It's really interesting because a little later I'll speak in an interview I did with the incoming chief executive of Telstra. And one of the things about that is I did note in that sector that Optus is already putting up prices. Now, when you think about something, it's almost a service as distinct from a commodity. When you think about a telco raising prices, you realise that the cost pressures are getting right throughout and very deep into our economy.
Absolutely. It's no longer just a rise in freight costs or petrol prices or goods only. It's starting to recirculate back through other parts of the economy, through the service sectors, and it's also highlighting just the acute shortage of labour in our labour market at the moment. Nearly 400,000 or 480,000 job vacancies we found a few weeks ago.
But that point also is that if business sentiment is now starting to come off, I wonder whether business hiring intentions will also start to drop off as they start to really look to the future and say, well, really, do we really need that extra 10 people if we're heading into something that's pretty tough next year? I just wonder at what point that starts to catch up, and maybe having this very tight labour market might just start to ease off as a result of what businesses will face in the future.
Well, ultimately, that's what the RBA is going to be looking for, is the first signs that the demand side of the labour market is starting to cool and that it's got a reasonable chance of managing inflation medium term. We are transitioning from the early stages of a tightening cycle where we've been going from ultra low rates, we're having to get back to something like neutral very quickly, to a phase where we're going to be sort of more watching and learning as to what's happening. The rates are clearly biting around confidence, and they'll start to show a bite with biting in the housing market. They'll start to show a bite across the wider economy. And when we're now into that neutral zone, which is probably still about 50 basis points away, but beyond that, it's now a case of, well, we need to wait and see how the economy bears up, how much of a slowdown starts to come through the labour market, and the central bank will start to take a more pause and move sort of tactical approach to its rate tightening.
Because one of the points that we've been trying to make on this program is that the problem is not necessarily the thing that started this inflation bubble, which was energy prices. It's actually once wages inflation gets into the system that it's much harder to get out. And that's where you might need even higher interest rates even in the future than what we've got now if that wages inflation takes off. So strangely enough, if the Reserve Bank is quick enough to catch the wages inflation, it might save the economy and might save homeowners and might save really future interest rate rises much higher than what we otherwise might receive.
Absolutely. And the spectre behind all of this is obviously the 70s period of stagflation, where it took 10, 15 years to really wring inflation out of the system entirely. It's a very different economy now than it was in the 70s and 80s, but having to face a more prolonged fight against inflation raises the spectre of not being able to ease rates to lift the economy when it slows because inflation is still too high, maybe having to go again and leave rates at a sustained much higher level for a longer period. So it's always been about trying to catch that second round effect. The initial pulse, we had no hope in stopping that. It really was so large and came so suddenly that it was impossible for us to really counteract energy and freight costs that were rolling through the goods side of the economy. But for policy, it's about trying to stop that secondary recirculation of price pressures that becomes embedded in a multi-year inflation.
And so that's going to be the big thing. And so tell me just very quickly, we've just only got 20 seconds, where is Westpac seeing the peak of interest rates from the Reserve Bank now?
Look, we think they'll go another 50 in August and then pause. They'll have more to do because this is a serious inflation threat that we're facing into, particularly around the labour market. It's going to take a significant slowdown on the demand side and some improvement in supply. We think they'll take the cash rate to 2.6, so into tight territory. But beyond August, it'll be more business as usual, 25 basis point moves.
Matthew Hassan, always good to have in the program, Senior Economist at Westpac.